It's hard to know how much money you'll really need in retirement. In fact, a recent Which survey found that 51% of people yet to retire said that they weren't confident about how much money they'll need to deliver a comfortable retirement. Now imagine trying to figure out how much money you'll need for an early retirement and achieving financial independence, and then on top of that, working out how long it will take you to get there. For those new to the financial independence concept, it essentially means that you've built up enough wealth to cover your lifestyle expenses forever without needing another paycheck. And usually those targeting FI want to do so significantly before the standard retirement age. If FI was the same as standard retirement, we might as well just call it retirement. FI is different. It's about freedom of choice. Now you may use that freedom to stop working, or you may not, you may carry on working. The point is, you have the freedom of choice to do what you want, when you want, without needing to worry about money. This whole movement around financial independence is still quite new to the UK. The movement has been heavily US focused, but on this channel I want to provide a UK flavour to FI. And if you think this kind of content will be interesting to you, then please hit that like button, as it really helps let me know that I should continue with this FI series. In this video, we'll be covering two key questions around financial independence in how to calculate your FI pot and how long it will take you to get there, breaking this all down into 3 simple steps. Before we begin, as always, I need to say that this is not financial advice, and please do your own research. Now we've got that out of the way, let's get into it with the first step. Step 1 is all about figuring out your annual lifestyle expenses. We need this as a starting point because your FI pot is essentially just a pot to fund those expenses indefinitely. Like with retirement, it's not always obvious what you'll spend when you reach the point of financial independence. Some costs might go down, like commuting or a mortgage if it's paid off, while others may rise, like travel or hobbies. This makes it incredibly difficult, but we only need a rough figure, and there are 2 easy methods we can use to give us this. Firstly, using your current expenses, looking at your annual spend today and adjusting based on your goals and expectations on what you think your lifestyle could look like at the point of FI. Secondly, alternatively, we can use the ready-made retirement living standards. This is essentially a framework from Pensions UK showing how much someone may spend at retirement across 3 different living standards in minimum, moderate and comfortable. And they also show how this differs if you're in a couple or if you're a single person. These figures include allowances for essentials like housing, energy and broadband, and they also include discretionary spending for things like holidays and hobbies. They're not perfect, but they give a benchmark target, which we can tweak for our own lifestyles. And although they're retirement focused, not financial independence focused, they still provide a good baseline. I personally used these standards as a starting point when calculating my own pot size. Ultimately, whatever method you choose, you should now have that annual expense figure. You might be thinking that number is going to change over time because of inflation. And you're right, you're 100% spot on. But hold that thought for the time being, as we'll be leaving inflation for later, building that into when we work out your timeline and how long it will take to reach FI. For now, let's move on to step 2 in calculating your FI pot size. The obvious question now is, how the hell do we use this annual expense figure to work out the FI pot size? This is actually more simple than you might think, and some may say it's even more simple than planning for a traditional retirement. As for a traditional retirement, your annual expenses would often come from a mix of the state pension, a defined benefit pension, annuities, or a drawdown or lump sums from defined contribution pensions. So when planning for retirement, you need to consider how all of these sources come together to cover your expenses. But for FI, especially early FI, most people will only be relying on the drawdown method in withdrawing a percentage of their invested assets each year to fund living expenses. In the UK, your invested assets will likely be sitting in a combination of ISA and pension accounts. The exact split between these accounts will likely depend on when you want to reach FI, since you can't access private pensions to the age of 55 currently, and this is due to increase to 57 from 2028. You might even decide to use another method as part of your FI strategy, but that's for another video. For today, to make it simple, we'll assume that you'll solely be using the drawdown method to take money out of your FI invested asset pot to cover your annual expenses. This means the final part of the puzzle to work out how much you need to be financially independent is understanding your rate of withdrawal, the percentage of money you take out of your portfolio each year to fund your living expenses forever. This is where the 4% rule comes in, and you don't need to go far in the FI or wider FIRE literature to have heard of this. The 4% rule started with William Benjamin in the early 90s. He analysed historical US stock and bond returns and found that a retiree could withdraw 4% of their portfolio in the first year, adjust for inflation each year, and the money would still last 30 years. This was then reinforced and popularised by the Trinity study in the late 90s. This simulated hundreds of portfolios, withdrawal rates, and timelines based on historical data. But out of all the models from the study, the media focused on just one, a 4% withdrawal rate, 50-50 stock bond portfolio adjusted for inflation. In this case, it was found that withdrawing 4% in the first year and then adjusting for inflation every year after led to the portfolio surviving 96% of the time over 30 years. That's a crazy high success rate. In fact, it only failed in two particularly unlucky starting years, right before the Great Depression, and then secondly before the stagflation era of the 1970s. Outside of those scenarios, most portfolios with a 4% withdrawal rate not only survived, they often grew beyond their original amount after 30 years. For example, they found that the median value of a 1 million 50-50 stock bond portfolio after 30 years with 4% inflation adjusted withdrawals was 2.9 million. So on average in this scenario, the portfolio grew by 1.9 million after 30 years despite the withdrawals. The results are even crazier for a 75% stocks, 25% bonds portfolio, as the median value of a 1 million portfolio after 30 years came to almost 6 million. And for a 100% stocks portfolio, they found that the median portfolio grew to over 10 million. Nonetheless, the key takeaway from this study for most people is that a 4% withdrawal rate over 30 years gives a high chance of not running out of money for portfolios with 50-50 bond stock mixes. Now we know how the 4% rule typically works, let's talk about how we can use it to calculate our pot size. A 4% withdrawal rate means we simply need to multiply our annual expense figure by 25 to get our FI pot. For example, if we use the retirement living standards and look at what this would mean for a single person aiming for a minimum lifestyle, here we'd simply multiply 13,400 by 25 to get our FI pot figure, which would be 335,000. That's the ballpark figure using the classic 4% rule. However, we can't stop there, as although this rule is a pillar of the whole FI and FIRE philosophy, it comes with caveats, which means it's far from bulletproof. For this video, let's quickly talk about 3 of the caveats which are most relevant to your FI pot size, as you need to be fully aware of these and how you can protect against them. The first big caveat is the 30-year assumption. FI often means retiring in your 30s or 40s, which could lead to 40 or 50 years of retirement, longer than the Trinity study's maximum timeline. There's also a sequence of returns risk. This is the risk that you retire at the wrong time, just before or after a recession, and your portfolio is cut massively. This is important as early losses reduces your portfolio's ability to recover, and this is why in 4% of the cases for the 50-50 portfolio, it didn't last the entire 30 years. There is also a big third caveat in that the 4% rule is entirely based on past data. The future may not be the same as the past. We may not get the same performance from the stock market or bond market. That's why you hear the disclaimer, past performance is no guarantee of future results. in nearly every finance video you see on YouTube. The next question is, how do we protect against these risks, against these caveats? The main way is to have safety nets in place to protect damaging the pot size too much in the beginning and increase the chance of extending its shelf life beyond 30 years. You could do this through various different strategies, such as using dividend-focused portfolios or equity release later in life, but the mitigation strategy which stands out to me is using a cash buffer. A cash buffer is a few years' worth of expenses held in a cash savings account or in low-risk investments such as money market funds. So how does this help? Well, it shields you from selling investments at a loss during the first few years if you reach FI at a time when the market is going down. So it protects against a sequence of return risk as it allows your portfolio to recover naturally whilst you live off the cash in that period. It also allows you to build a flexible withdrawal plan beyond the 4% rule to plan for retirement or financial independence timeline, whatever you want to call it, beyond the 30 years in the Trinity study. It allows this as during the bad years, you can use the cash buffer to fund your living expenses so you're not needing to take money out of a falling portfolio. Then in the good years, you can top back up that cash buffer, helping to extend your portfolio's lifespan. Now, next, let's talk about how much could be needed as a cash buffer. You ideally want your cash buffer to see you through a bad market downturn, so there's no need to take money out of your portfolio in this period. Historical data shows that the average time it takes for a market to recover after a crash over the last 30 years is around 3 years. The number of years you might want as a cash buffer is entirely based on what you're comfortable with, and you might not even want a cash buffer. It's entirely your choice, your plan. But let's take an example where we use 3 years as a cash buffer and see what it would mean for the FI pot size. This would essentially mean that we'd need to add 3 more years of living expenses to the pot. So using the retirement living standards for a single person on the minimum lifestyle, we'd add a 3-year cash buffer equating to £40,200 to their £335,000 financial independence pot, leading to their total FI pot, including the buffer, being £375,200. That extra cushion does increase the pot size, but it gives our FI plan resilience and flexibility. However, ultimately, whether you've added a cash buffer or not, you should now have a magic financial independence figure, the pot size which will give you freedom. It's important to remember that your FI number is highly personal, and only you will know what will work for you. Now that we've got the pot size, let's move on to the final step in going through how long it will take to reach this pot figure. This depends on how much money you can throw at it. This is the fun part of the process, seeing how your savings and compounding can actually get you there. And let's bring up a compound calculator to show what I mean. With this calculator, we need to make some assumptions. First, the rate of return, and here we'll account for inflation. For the purposes of this example, let's use the average return of the US stock market over the last 100 years, which is around 10.5%, and then minus the average inflation rate for the UK over the past 30 years, which is around 2.8%. Doing this means we account for the reduced purchasing power of our money over time. So if we minus 2.8 from 10.5, we get a 7.7% inflation-adjusted rate of return. Now we need to add the number for our initial investment pot. So this is the amount of money you currently have in investment accounts or any account which you plan on using as part of your financial independence pot. Let's put 50,000 for this example. Next up is how much we can contribute each month, and then finally the number of years. You can play around with these numbers to see how quickly you can reach your financial independence pot. For example, if we wanted to achieve a pot size for the minimum single standard of living at £375,200, let's say we can contribute £1,000 every month, and now we need to play around with the years and months until we get to the pot size of 375k. For example, if we input 12 years, we just fall short, and if we input 13, we overshoot. But if we put 12 years and 5 months, we're getting pretty close. If we could free up a bit more money each month and invest £1,500 a month instead of £1,000, we could get there even quicker at 10 years. Here you can see how the pot can grow fairly quickly thanks to investment return and compounding, with over 147,000 of that pot made up of investment return. Of course, the amount you can contribute will depend on your circumstances. For high earners, contributing $1,500 every month may be possible, and you could reach your financial independence number at good speed. But for lower earners who need to prioritize other goals, like housing or kids, it may take longer. Even if you can squeeze £100 from your spending in the early days, it's a start. Aim to play around with these numbers until you have a realistic plan for you in terms of how much you can feasibly contribute each month to achieve your FI pot, and then you'll have a gauge of how long it will take you to get there. Of course, you may also choose to adjust the return, as we're making a big assumption here in using the past performance of the US stock market and past inflation, so you may want to be less aggressive with this figure. Nonetheless, whatever speed is right for you and your circumstances, to talk about reaching financial independence in timelines such as 12 years, like we have in this example, is just bonkers to me when compared to the normal working lifespan when someone tends to work from the age of 20-21 to the state pension age of 68. This plan offers an alternative, and I hope in this video it's given you a few ideas around what your FI pot size could be and how long it could take you to get there. I do need to say that we've made a lot of assumptions in this video, and I want to point out that using the 4% rule and looking at the past performance of the stock market is not perfect, given all the caveats we've gone through, but it does give us a starting point. We've also not considered things like the impact of getting the state pension in later years, whether you could remortgage or use equity release as part of your FI strategy, or the impact of tax when withdrawing the money from your pot. So if you're thinking about FI, please do your own research to build your own strategy suited to your own circumstances. In terms of this video, let's recap on the 3 steps we've gone through. We firstly estimated our annual expenses at the point of financial independence by either using our current spending or the retirement living standards as the baseline. Then we worked out our FI pot size by multiplying our annual expense figure by a minimum of 25. Or if we wanted to add in a cash buffer or a different form of resilience, that number went beyond 25. Then finally, the third step was all about working out how long it will take us to build our financial independence pot. If you enjoyed this video and want me to continue with this financial independence series, then please give this video a like, as if it gets over 50 likes, then I'll plan more videos on this topic and go through things like UK-friendly accounts, strategies, and investments for financial independence. But for now, thanks for watching,